OneLogix has just recently announced its interim results for the period ending 30 November 2011, with which we're reasonably happy. We're able to report headlines of revenue up 30%, operating profit, which excludes items of a capital nature, up 23%. Our total comprehensive income is up 35%. HEPS, headline earnings per share, up 18%. NTAV up 25%, and a distribution of 4.5 cents per share. Now, typically, historically, our business has had it does perform marginally better in the first 6 months than the second 6 months, primarily because there's more trading days in the first 6 months. The balance of our period has the Christmas period, January starting a bit late, February a short month, March and April littered with public holidays, which have an impact on our earnings. So we always let the market know that the first 6 months is marginally better than what the second next 6 months would be. But time will, of course, tell whether that historical fact actually repeats itself going forward. OneLogix is a niched logistics operator. It operates in very clearly defined markets, principally because of the size of the business, and we try and make sure that those niches that we operate in are ones that we reasonably dominate, or at least we are substantial players in the market. And to varying degrees, those niches have comparatively high barriers to entry, and as a result of that, the margins are reasonably poised, and as a result of all that, cash is a reasonably healthy situation for all of us. Over the last 5 years, we've had a look at our compound annual growth rate, and we were quite buoyed to see that we, on all metrics, are growing pretty much around 30% plus. And in fact, if you look at our cash generated from our normal operating business, it's well over 40%. So we believe that this business is sustainable. It's rooted itself very strongly. It is a strong base we believe that we can build on going forward, and there's no reason to think that the performance of the past should be able to be replicated going forward. But of course, that depends on a whole host of plans that we have in place actually being able to be executed properly. So yeah, we think that this business is still yet to come of age. The debt to equity ratio of the group is below 50%. We're happy with that. We are in a growth phase. We do typically own our own properties simply because landlords would not find us as an attractive tenant because we have such peculiar requirements. And so you'll find in our PPE line, our property, plant and equipment line, there's a lot of property, and of course there's assets which are, because we're an asset-rich company, typically the big fleets that are with BDS and now RFB, increasing the size of their fleet, and even OneLogix projects, including increasing the size of their fleet. So it's typically property and the trucks that are on the PPE line of our group. The OneLogix group commenced with a distribution of capital policy during 2010. In this period of reporting, we have a dividend, or in fact also a capital distribution of 4.5 cents per share. It works out to, in fact, about 4.5% as a yield. We're pretty comfortable with that. Clearly that's something that we look to sustain as we go forward, of course depending on the nature and the context of the performance of the business. I think it's going to depend on what happens in the marketplace, also whether our plans come together, but there's no reason to think that we shouldn't have a successful second half.